Howdy folks, Joe DeSanto here. Thanks for joining me. Okay, in this video we're going to talk a little bit about ways to finance a roof replacement and what ways are better than others. So stand by for that. In the meantime, I just want to say if you like my content, please do the old like and subscribe. And I'd also like to mention that if you're looking to learn personal finance from top to bottom the easy way, I have a great course called Personal Finance Mastery that will teach you just that. So if that sounds interesting to you, check the link below. Okay, so what kind of financing options are there available to replace the roof on your house, or honestly any other big improvement on your house that becomes necessary? Some of the lending options I would say are a home equity line of credit. You could also do a home equity loan. I'll explain the differences of those things in a sec. Then, of course, there's the personal loan option. Probably next down from there would be a credit card. Not that I'm recommending that. And the last option I can think of is often roofers nowadays offer a financing program. Most likely that will use equity in your house as collateral, so it's kind of akin to a home equity loan. But let me go through this. So home equity line of credit is when you have equity available in your house, so you have a first mortgage or a single mortgage, but your house is worth a lot more than what you owe. You have some available equity. You get a line of credit that uses that equity as collateral, and you can draw on that line, pay it off, pay it off. It basically works like a credit card, but it's secured by your home equity. And why that is great is because generally the interest rate is far lower than a credit card. I mean, today, roughly, it's going to be a variable rate like a credit card, but it might be around 10%, whereas a credit card could be 20 to 30%. So huge difference there. Also, the interest would be tax deductible on your mortgage. Not on your mortgage, on your tax return. So you would end up having some sort of savings that way. Now, there's some caveats to that, so you got to talk to your tax professional if it really would work for you, but it is available as an option. And also, the last benefit of doing something that's secured is that it won't affect your credit score as greatly as having a personal loan or a credit card, which are unsecured debts. So I would go with a home equity product if possible. Now, a home equity loan is slightly different. It's oftentimes referred to as a second mortgage, but it's like you have a first mortgage, you have some equity, you borrow off that equity, but that loan works just like your first mortgage, where you take a certain amount out, you have a fixed payment for a certain period of time, 20 to 30 years, and you have a fixed interest rate. The problem with that is if you don't need all the money, you're pulling out all this money and you're paying interest on it, and if you don't need it for some particular purpose like a large renovation or whatever, it's kind of unnecessary. So that's why I like the home equity line of credit instead, because it's much more flexible. Now, a personal loan is when you go out and just get a loan based on your income or your qualification, but it's not secured by an asset. So it's somewhere in between a home equity loan and a credit card, in that you're going to get a lump sum of money, you're going to have fixed payment term and fixed payment amount, and probably a fixed interest rate. But the interest rate's probably going to be quite high. I'm going to say 15 to 20%. Credit card is the next one down, also unsecured. I like credit cards because, like the line of credit, you can use them, pay them off, without easily, and you only pay interest when you have the money drawn out. The biggest problem there is the interest rate is very high, 20 to 30%, and it will affect your credit score. If you have a $30,000 credit card and you've used $25,000 of it, you have a high usage to credit ratio, which greatly affects your score. It's one of the biggest effectors of your score. So finally, we'll talk about what the roofer might have as an option, which is a financing option. My guess is that is going to be somewhat like a home equity loan. You're going to get an amount of money to repair the roof. They probably would put a lien on the property is my guess, so they might have a second position lien like the home equity loan. That's my guess, though. That may not be true. And if so, it's going to be a secured loan, which will be better for your credit. The only problem is you end up with, if they do the second lien and say that roof is only $20,000, you now have a second lien on your house for a small amount of money. So if you go to get a home equity line of credit later or refinance later, you'll have to refinance out that amount so they can come in and get that second lien position. So that's not really a big deal, to be honest with you, but just something to consider if in fact they put a lien on the house. If they don't for that kind of loan, it's essentially akin to a personal loan. It'll probably work just like that. It'll be an unsecured loan, and it'll affect your credit more so than a home equity product, probably a little bit less so than a credit card, but it's going to be similar to a credit card. All right, hopefully that was helpful. Thanks so much for tuning in, and I will see you in the next one.